A dividend is a payment made by a company to its shareholders, usually in the form of cash or additional shares of stock. It represents a portion of the company's profits that is distributed to its shareholders as a way to share the financial success of the business. Dividends are a way for investors to receive income from their investment in a company's stock. Here's how dividends work and how they provide shareholders with income. Profit distribution. When a company generates profits, it has several options for using those profits. One option is to reinvest the profits back into the business for expansion, research and development, or debt reduction. Another option is to distribute a portion of the profits to shareholders in the form of dividends. Declaration by the Board of Directors. The decision to pay dividends is made by the company's Board of Directors. The board considers various factors, including the company's financial performance, future growth prospects, and capital needs. If the board decides to pay dividends, they declare a dividend per share amount. Dividend per share, DPS. The dividend per share is the amount of money allocated to each outstanding share of the company's stock. It is calculated by dividing the total dividend payment by the number of outstanding shares. Payment frequency. Companies can choose the frequency with which they pay dividends. Common options include quarterly, semi-annually, or annually. Some companies may also pay special dividends in addition to regular dividends. Cash dividends versus stock dividends. Cash dividends are paid in the form of cash directly to shareholders. Stock dividends, on the other hand, involve distributing additional shares of the company's stock to existing shareholders. Yield. Dividend yield is a measure of the income generated by a stock as a percentage of its current market price. It is calculated by dividing the annual dividend per share by the stock's current market price and multiplying by 100. Income for shareholders. For shareholders, dividends represent a source of income from their investment in the company. Investors who rely on regular income may be attracted to dividend-paying stocks as a way to supplement their cash flow. Stability and growth. Companies that consistently pay dividends are often seen as stable and financially healthy. Regular dividend payments can also signal confidence in the company's future earnings and cash flow. Tax treatment. The tax treatment of dividends varies by country. In some jurisdictions, dividends may be taxed at a different rate than capital gains, and there may be tax advantages for certain types of dividends. Preference for dividend stocks. Some investors, particularly income-oriented investors, prefer stocks that pay regular dividends. These investors may include retirees looking for a steady income stream from their investments. Dividend reinvestment plans, DRIPs. Some companies offer dividend reinvestment plans, DRIPs, allowing shareholders to automatically reinvest their dividends in additional shares of the company's stock. This can help investors compound their holdings over time. It's important to note that not all companies pay dividends, especially those in high-growth industries that may prioritize reinvesting profits for expansion. Additionally, companies may choose to reduce or eliminate dividends during challenging economic periods or when facing financial constraints. Investors should carefully consider a company's dividend history, financial health, and future prospects before making investment decisions based on dividend income.